Hi, John McElroy here, talking all things automotive. Today, I want to talk about one of the key reasons why the stock prices from legacy automakers stink. I could use a stronger word to describe it, but hey, let's keep this clean and civil. Over the last decade, Tesla stock made a lot of millionaires out of ordinary retail investors. Not so with the legacy car companies. Their stock, with maybe the exception of Toyota, were terrible for long-term investors. Anyone who invested in them did not make much money or even lost money. Let's look at the stock returns of Toyota, Honda, Volkswagen, BMW, Mercedes, General Motors, and Ford. Out of all of them, Toyota stock put in the best performance. Over the last 10 years, it grew at a compounded annual growth rate, or CAGR, of 9.7% a year. That's for shares that were traded on the Nikkei, not for American depository shares, which were up less than 5% a year. Then Mercedes was the second best. Its stock returned a CAGR of 5%. GM came in at 3%, Ford at 1.6%, Honda at 1%, BMW at 0.14%, and Volkswagen was actually at a negative 1.5%. These are terrible returns, and if you factor in inflation, investors lost money on almost all of them. You see, Wall Street doesn't like legacy automotive stocks. Their price-to-earnings ratios, or multiples, are lousy. While the average price-to-earnings ratio on the major stock exchanges, like the S&P 500 and the NYSE, are around 28 or 29 to 1, the legacy automakers are less than half of that. Anyone investing in legacy car companies is going to watch their savings grow very slowly or not even at all. Here's why. Stock prices are a reflection of how the market thinks a company is going to perform in the future, not how it's doing today. A company can plunk down record earnings for a quarter, but if the market thinks that the next quarter is not going to be that good, the stock's probably going to go down. It's all about the future. And this is where the legacy automakers stink. They're not growing. Some of them are actually shrinking. In fact, on an inflation-adjusted basis, they're all shrinking. The data tells the story. I went through a decade's worth of annual reports of these legacy automakers. I looked at a decade because I wanted to see what kind of top-line growth they were generating year in and year out. And here's the bad news. I couldn't find any growth, or at least not very much. Even though these automakers report billions in profits every year, they are not growing. And that's a key reason why their stock prices stink. Mercedes did the best of the legacy automakers that I looked at. It grew its revenue by 53 billion euros over the last decade, which sounds pretty good, except that it was over a decade. In other words, Mercedes only grew its top line by an average of 5.3 billion euros a year. That's less than 4% a year. And after you account for inflation, it really hasn't grown much at all. Toyota was the next best. It grew its top line by 3.2 trillion yen, which sounds like a lot, except that translates into a compounded annual growth rate of only 3.5% a year. And that's not counting inflation. One other thing worth noting about Toyota is that it's the only legacy automaker that had higher revenue last year than it did before the pandemic. None of the others have recovered from their pre-pandemic levels. Okay, next on the list is Volkswagen. From 2012 to 2021, it grew its top line by 9.3 billion euros. That's an annual growth rate of only 2.6%. Honda grew by 1.7% a year. BMW only grew 1.4%, and then it gets really bad. Ford and General Motors did not grow at all. They shrunk. In terms of how much money they bring in, they're smaller than they were a decade ago. And that's before you even account for inflation. Ford brings in $10 billion a year less than it did a decade ago. GM brings in $25 billion less. They had a negative growth rate for a full decade. And this is a key reason why GM and Ford have the lowest price-to-earnings multiples on this list of legacy automakers. Now, there is a bit of an excuse for GM as to why its revenue is lower. It got rid of Opel, it dropped out of the European market, and a bunch of other world markets. so it lost a lot of revenue that way. But even since then, GM's revenue has been on a downward slope. Meanwhile, over the same decade, Tesla grew at more than 60% a year, 62.7% to be exact, and that's a key reason why its stock has been a darling of the market. At some point, Tesla's growth rate will start to slow down, and in fact, it already has. Over the last 3 years, Tesla's top line grew at a compounded average growth rate of 30% a year, or half of its prior rate. That's still pretty healthy. And with the Cybertruck and Semi right around the corner, with Berlin and Austin still getting up to line speed, and maybe with FSD really ready for prime time, Tesla will keep pushing its top line up far faster than any of the legacy automakers. The importance of how a company's growth rate affects its stock price was underlined when GM CEO Mary Barra laid out a detailed public roadmap for how she's going to double the company's revenue by the end of the decade, thanks to a full lineup of electric vehicles and subscription services and robo-taxis and OnStar and GM Defense and several other business ventures. All of them have specific dollar goals that they have to hit. Last year, GM did $127 billion in revenue, but Barra wants to grow that to somewhere between $275 billion to $315 billion by 2030. That's a big increase. But to put it in perspective, it means GM's top line would grow at about 10% a year, which is pretty good, but it's still about 1/3 of Tesla's current growth rate. Even so, you got to give Mary Barra credit. At least she's talking publicly, specifically, about how she's going to grow the top line. You don't hear much of that kind of talk from her compadres. Ford has talked about growing its commercial business, what it calls Ford Pro, from $27 billion a year today to $45 billion by 2025, but it hasn't spelled out any specific growth targets for the whole company. And all the other legacy automakers are talking about how much money they're investing in electric cars and how they're going to unlock more value from within their company and how they're going to improve their margins. But you don't hear them say much about top-line growth. Maybe as lofty goals, but not with any specifics. And so it seems obvious to me that the stock prices of these legacy companies are going to underperform the stock market for a long, long time to come. Because who wants to invest in companies that aren't really growing at all? Say, if you like these videos and this kind of analysis, I invite you to subscribe to the Autoline channel if you have not done so already.